Welcome back, everyone, to the Audacious Money Witch channel, where we talk about investing and trading and a lot of fun things. The problem with Jeremy's cake stock and why it's valued cheap.
I have a problem, big problem. Stock I sold is Texas Roadhouse. You can only fit so many people in your restaurant, right? And hiring and wage problems. They deal with the same thing, but the difference is cake trades at a forward P of 10, right? Which is dramatically different than, let's call it a Texas Roadhouse, right? When I look at a stock like Texas Roadhouse, it's been a tremendous performer. It's 2x'd roughly the S&P 500 over the past 5 years. But if I'm thinking about the next 5 years, which is my time horizon, I think there's a pretty decent probability that Texas Roadhouse will just market perform the next 5 years or even underperform the S&P 500 over the next 5 years because the valuation's gotten pushed so much now at this point in time, especially if I'm concerned that the stock's going to underperform the market over the next 5 years. It doesn't make sense. And so that's why I had to sell a great company like a Texas Roadhouse. I went ahead and bought 4 contracts on CMG puts here. I paid $16 a piece for those. Now, why CMG specifically? Great company. There's no debating CMG is a great company. Burrito chain trading at ridiculous valuations, right? My hedges I have for this particular portfolio are CMG because Chipotle is a very high valuation name. Those are the sorts of stocks that get pounded if you got any weakness in the market.
Well, I think it's almost impossible if you're to do well in equities over a period of time. If you go to bed every night thinking about the price of them, I mean, Charlie and we think about the value of them. If they close the stock exchange tomorrow, it wouldn't bother me and Charlie at all. We would keep selling bricks, selling deli bars, selling candy, writing insurance. You know, a lot of people have private companies and they never get a quote on them. You know, we bought See's Candy in 1972. We haven't had a quote on it since. Does that make us wonder about how we're doing with See's Candy? No, we looked at the company results. So there's nothing wrong with focusing on company results. Focusing on the price of a stock is dynamite because it really means that you think that the stock market knows more than you do. Now, the stock market may know more than you do, but then you shouldn't be in stocks. I mean, you should have, the stock market is there to serve you and not to instruct you. So you need to formulate your ideas on price and value. And if the price gets cheaper and you have funds, you know, logically you should buy more. And we do that all the time. Where we make our mistakes, frankly, is where we focus on price and value and we start buying and the price goes up a little and we quit. You know, like Charlie referred to, we might have done on See's Candy. A mistake like that cost us $8 billion in the case of Walmart stock a few years ago because it went up in price. You know, we are not happy when things we're buying go up in price. We want to go down and down and down.
We just learned that Jeremy Financial Education sold his Texas Roadhouse stock because he wants you to buy his Cheesecake Factory stock. Today, I want to dig deep into this cake stock and do an analysis and look for the reason why it's cheap, like Jeremy says. First, I have to say, I really like this brand. Who doesn't like cheesecake? Yummy, right?
Sensitive girl who comes to LA from Lincoln, Nebraska to be an actress and winds up a waitress at the Cheesecake Factory.
So it's based on your life.
No, I'm from Omaha.
The Cheesecake Factory, named to Fortune 100 Best Companies to Work For, listed for the 11th time. People like working there. They have a special company culture. In today's video, we're going to predict its cash flow in the future. We need to look for the economic moat or some kind of long-term competitive advantage that this company may or may not have. We need to assess management in terms of their integrity to shareholders, as well as their skill at making decisions within the business. And at the end, we'll do our intrinsic valuation, where we'll estimate how much cash we can expect to get out of this company over the long term, and therefore how much we should be willing to pay for it. Are you ready for it? As Taylor Swift says. The Cheesecake Factory was the first restaurant in the upscale casual dining segment, which started in 1978 at Beverly Hills. Do you know what company is also in Beverly Hills? Playboy. Cake stock reminds me of Playboy stock. Cake currently operates at 334 different restaurants in the United States, Puerto Rico, and Canada. And 216 of those are under the Cheesecake Factory brand. And then they have a handful of other brands like North Italia, Flower Child, that have a couple of restaurants and bakeries. Let's zoom in on the part of what Buffett called the circle of competence, analyzing the competition of the Cheesecake Factory. In the restaurant industry is highly competitive, and the Cheesecake Factory competes for customer traffic from other casual dining restaurant chains such as Texas Roadhouse and Buffalo Wild Wings, as well as home delivery services, mobile food services, grocery stores, and meal kits. So as you would expect, the restaurant industry is highly competitive. There is a lot of customers, but there's also a lot of choice. And you're not just competing against big chains, you're also competing against single restaurants. People who have just started a restaurant, you're competing against all of these other things, such as delivery services. If you're going to capture a large proportion of that industry, you have to have some kind of competitive advantage. Make sure you dig deeper and understand what actually drives these restaurants and what's happening within the industry. When there's a lot of positivity, they're going to build a lot of restaurants, and that's going to lead to oversupply, which means that restaurants aren't going to perform as well. Look at the economic moat. We need to see if we can identify any of these unique advantages that this company has over its competitors. Because, as I said, the restaurant industry is very competitive. So if these restaurant chains are going to survive, they need to have some uniqueness about them that allows them to draw in more and retain those customers and that money. Over an extended period of time, the advantage that these chain restaurants are going to have is that they have a brand. Customers are going to recognize the restaurant chain and consistently come back there because they like the food and the service. Let's see what their numbers look like and whether or not they tell us anything about a competitive advantage that this company may or may not have. Revenue growth has been very consistent, but extremely slow, especially in the most recent quarter. It actually declined. Net income is pretty much consistent. Equity growth has been actually declining significantly in the past couple of years. And then we have free cash flow, which again has been slowly declining, whether you look at it quarterly or annually. So from my understanding of the restaurant industry and how a branding moat is one that can be eroded over time, it's not that strong. And looking at their numbers that are pretty weak, we can conclude that they don't have an economic moat. They don't have an effective competitive advantage. It's possibly that they have small advantage that's allowing them to still be successful in this industry. They're one of the best restaurant chains in this industry. Because they don't have a competitive advantage, we can't be confident that over the long term, they're going to continue to perform well. Because without a moat, any other company can just come in and do something slightly better than this company, for example, and take all of their customers or take a significant amount of their customers. We need to know that our businesses have some kind of protective layer around them so that we can be confident in estimating into the future and be confident in investing that we're going to get back at least what we invested in the first place. We're shareholders, we own the company, and that means we have to assess the board of directors. and the executives management, and they will be making decisions about where to put money in order to grow it into more money. To assess management, we look into their capital investments. How effective are their investments? Are they generating a high return? How much debt are they willing to take on? We need to make sure that they're not taking on an overwhelmingly amount of debt. And of course, if they have too much debt, that leaves us with the risk of losing our entire investment of the company, going bankrupt, and we can easily avoid losing all of our money by just investing in companies that of course have a competitive advantage and a management that has integrity and is good at investing, but one that doesn't have much debt at all, so that the risk of going bankrupt is really non-existent. So does the Cheesecake Factory have a lot of debt? Hands down, without a doubt, it has a lot of debt compared to its cash. So as of January 2nd, 2024, which is our latest data for the Cheesecake Factory, they had total current assets of $300.8 million and total current liabilities of $660.67 million, which gives them a current ratio of 0.46. Now this is far below our minimum we are looking for, a current ratio that's above 2. That's pretty bad. Next, let's have a look at their total debt compared to their total equity within the company. Total liabilities as of January 2nd, 2024 was $2,522 million, and they had equity of $318.06 million, which gives them a debt to equity ratio of 7.93, which means they have 8 times more debt than they have in equity. Again, well above our maximum. So we're looking for below 0.5. So looking at these two ratios, we can look at their short-term and their long-term debt compared to what they can use to pay it off. And the Cheesecake Factory does have way higher than average, a lot higher than what I'm looking for. Their debt is like stacked up and loaded into the sky. Dang, this is holy smokers. This ain't no jokers. Debt levels, wow. You've got to be aware that if a company takes on debt, they need to pay it back in the future. So their ability to make those future payments could impact whether or not you have a business in 5 years or not. For me personally, I would just stay away. Finally, that brings us to do an intrinsic valuation, calculating exactly how much we should be willing to pay for it. Up until this point has shown us that they don't have a distinct competitive advantage that I can identify, in my opinion. You might have a different opinion. Let me know what you think in the comment section below. Using my analysis, I don't even have a lot of confidence in this company in projecting their cash flows into the future. So just keep that in mind when we're looking at this, even though we're being conservative. We still really shouldn't have any confidence that they can achieve this, because they just haven't been able to show us that they are consistently good business. For this intrinsic value, I did a discounted cash flow to calculate how much we should be willing to pay for it. Owner's earnings is a Warren Buffett's concept. 5 years average for the cash flow for owners is $72 million. So I put $100 million in owner's earnings. That's an estimate that I've made of how much cash we could have expected to get out of the cake stock in 2024. I am using Model 3. As you can see, we're targeting a 10% return so that it beats the market and you can collect a dividend. We apply a 20% margin of safety. We got an intrinsic value of $1.4 billion for the whole company and a buy price of $22 per share. Now it's traded at $34 per share with a terrible amount of debt. This is the reason why it's so cheap.